Good afternoon, everybody, or morning or evening, wherever you are. I know that we have people from all over the world who join us here. Great to be with you again. Ping me if you want to let me know where you are. Today is Tuesday, August the 13th. Yep, 12 p.m. And we've had some volatility in the markets over this past week plus now, and going into the CPI tomorrow, the Consumer Price Index, which the markets and the prognosticators are putting a lot of weight on. Croatia, great, welcome. And expecting a lot of volatility tomorrow. So depending on where the CPI comes in, could be very determinative of what the Federal Reserve does. And so we're expecting a lot of volatility. So I wanted to get into talking about managing exposure and volatility and diversification today, because I think it's very important. Anybody who was in the markets Sunday night to Monday morning, and through the week, knows what increased volatility is like, right? And, you can be, this is one of those situations where when things get this volatile, you can be right and still lose a ton of money. So trading market cycles, right, is not just about the signals. It's not just about the cycles. It's about managing our exposure, managing our risk tolerance, how big our position sizes are, etc. So those are big things. And it's one of that's an area that I've been working on a lot over the past couple of years, because I think it's one of the most, it's probably the most overlooked area by especially the retail audience. And so I want to dig into it a little bit today. I had hoped to be able to show it in my new RiskSmith tools, but they're not quite there yet, hoping next week. So today we're just going to continue to focus on what's going on in the futures markets as I've been trading them, and then just show how some of these trades fit together and how, what to do when volatility increases. So pretty happy with what we looked at last week. We looked at the yen dollar ratio, and the cycles suggested that we'd probably see a relief in that pressure. And indeed, that's what we've gotten over the past week. Equities have gone up, and the yen has gone down. Meanwhile, today, we're getting a little bit of reversal there. But it's been a very interesting time, and I think the cycles have been serving us well. So getting into it today, I'm going to go ahead and share my screen here. Give me a minute to just make a few adjustments here. And we're going to look at some of the trades that we've been following since we started this show here. So let me go with, I'm just going to go full screen here. And this is my kind of master view now of what's going on in the markets with both trend and cycles in different asset classes. So I know this looks like a ton of information on the screen, but we're going to use it just to drill down a little bit and see what's happening with some different assets that we've been focused on. Okay, so the way this works is these row headers here, okay, this first section here, all the way out to here, these are my trend indicators. So I've got 20-minute trends, 2-hour trends, daily trends, and I'm looking at them kind of all cumulatively together. So right now we see in equities, the S&P, the NASDAQ, the Dow, the Russell, we've got some bullishness in the 20-minute trends. little bearishness in the 2-hour trends, but definitely still bullishness in the daily trends. Okay, so that's how this works. And then over here are my cycles indicators. I've got 20-minute cycles, 2-hour cycles, daily cycles, and weekly cycles. What I want to draw attention to first is that the 2-hour cycles in the S&P and the NASDAQ are bullish, and they have been for a little while now. Okay, and we can go look at, for example, this 2-hour cycle in the S&P 500, the E-mini S&P. And we can see that cycle bottomed back here on the 5th and has been pointing up. This is the 259 period cycle, the one that sticks out on the spectrum the best, the one that's #1 ranked by the AI for the 2-hour data. And this still has room to run. And we got a cyclic RSI buy here. And momentum is still pointing up. So let's update this one to incorporate the latest data. I don't expect we'll see much change. All right, so in the S&P E-mini, we've got bullishness on the 2-hour cycle. I think the same thing is true in the NASDAQ. So let's see, yep, the NASDAQ. Let's go look at the NASDAQ 2-hour cycle. Grab all the latest data. Update our analysis. And again, we've been focused around this 300 period cycle in the NASDAQ. And again, we see lots of bullishness from the cycles. Cyclic RSI buy, momentum going up. So bullishness on the 2 hours in the E-mini and the NASDAQ. All right, now let's go look at the daily cycles. So again, ES is on the top here, NQ is on the second row. We'll jump over here, go and look at the daily cycles for the E-mini. Update them. Okay. And again, it's primarily this 83-day cycle. But also this, as it's 193 right now. So if we look at the daily cycles, okay, we still have got some bearishness on the daily cycles, but you know, the 2-hour cycles are solidly up. So that gives me caution. You know, I don't want to be backing up the truck and buying right now, but I'm also, you know, when I'm focused on a 2-hour cycle, I'm inclined to be long right now in the equities. All right. And if there's something that you would like me to cover, hello from Geneva. Yes, we'll do an update on Bitcoin. In fact, we're going to do that next because let's go down and see Bitcoin here. All right, here's my Bitcoin row. Okay. And if we go over here to the 2-hour cycles on Bitcoin, this is the cycle that one of the best cycles that I've seen ever. And it's topping right now. So let's take a look at the 2-hour cycle on Bitcoin. So we've been tracking this, you know, 118. We update it 115. And look at what's happening here. So this is the 1 week cycle, right? We had down week here, and then we had up week here. And I think we're heading into down week. At least that's the way I'd be betting right now. And if we go and look at the daily cycles on Bitcoin. So again, Bitcoin here. Tracking this. 259. Still 260. And we're definitely moving into the area of a bottom. I'd say we're within, the range where we could see a bottom here, but not quite there yet. Momentum. Let me try the tools here and see if we can zoom in a little bit. Yeah, so we got momentum turning up a little bit, but I wouldn't say that it's decisive. But definitely turning up there. So if I look at Bitcoin, to me, it feels, down week in Bitcoin. Maybe not today, maybe by tomorrow. But I think based on the 2-hour data, excuse me, I would wager on some downside in Bitcoin for this week, supported by the daily cycle lingering to the downside as well. All right, so we've got two different assets now that we've looked at on the 2-hour charts, okay? Long, let's say the E-mini S&P, and short Bitcoin based on the 2-hour cycles for at least the next few days to a week. I'm going to jump over here and I'm going to zoom in on this. All right, and I've set up a simple portfolio here. Sorry about my voice. But long 1 E-mini contract and short 0.2 Bitcoin contracts. So 0.2, a full Bitcoin contract is 5 Bitcoins. So 0.2 is 1 Bitcoin. So long 1 E-mini contract and short 1 Bitcoin. All right, let's look at, by the way, this is based on 2-hour bars. So right away, I can see this portfolio has a diversification score of about 42% and an exposure of $10,555. What does that mean? Okay, it means that if this portfolio of 2 positions, okay, went against me for 10 periods in a row. Here my periods are 2 hours. So 10 periods is about 20 hours or about 1 day in the futures markets. So it's kind of like a worst case scenario or a best case scenario. It's just volatility. If it goes for me, my best, 10 periods in a row, $10,000 is what I could potentially gain. Okay, as kind of that would be a big move. So I want to know kind of what I'd be facing with a big move one direction or the other. I'm usually thinking about it in terms of losses. All right. Now I've got this table here that tells me what are the next trades I might consider making that are least correlated to my existing portfolio. Okay. So ZB is Treasury bonds, the 30-year bonds. It's pretty uncorrelated at 1.44% correlation. Natural gas is pretty uncorrelated. We've been talking about natural gas. It's made a good move this week. We talked about it last week. I said, I've got a small position in natural gas. I want to be long for when we get that 20% move up, and that happened this week. So I'm long natural gas right now. I'm not sure about the next few days in natural gas, but I'm holding for a longer position into the fall. So some other options for us, the euro and the 10-year treasuries and gold, 5-year treasuries. These are all uncorrelated, relatively uncorrelated to our existing portfolio. So now I might want to look at one of these and see. Well, let's see. Going short treasury bonds would actually going long treasury bonds would reduce my exposure by $900. Let's go look and see what's happening with bonds. So here's the bonds section here. Okay. 2 years, 5 years, 10 years, 30 years. Definitely have bullishness in the trends, right? We've talked about bonds. That trade has worked beautifully. Ever since I said, teeing up for a long-term hold. The daily trends are still a little negative, but they're getting better. But we've really got positive trends here in the bonds. Cycle-wise, got some positive trends in the 2-year. If I jump back over here, where's the 2-year? Down here, 15% correlation. That's not bad. Let's look at the 30-year. Okay, bottoming on the 20-minute, the 40, the 2-hour bullish. So bullishness on the trends in the 30-year. So let's look and see if going long bonds, treasury bonds, looks like a good bet. This is the out of sample, worked pretty good. Let's look at that a little bit more. If we go over here, stretch that out a little bit. Whoops, where'd that go? So that's been working pretty well. Let's update this. This 152. And let's see which ones we were following on bonds. On the 2-hour, it's 344 and 81. All right. So it's this longer one out here. And 81 was right here. All in all, long treasury bonds looks pretty interesting. Even if I look at multiple cycles, the number 1 cycle, the ones we've been following, the 81, and even more bullish without the longer term cycle. But still, long treasury bonds looks like it could be a good bet. So let me go back here. Okay. And I'm going to now edit my other portfolio here, portfolio B. Yes. Long and how many units? So looks like 2.3 units. So let's just add 2 for now. All right. I'm going to rerun this now. All right, while we're doing this, let me know if there's other things you'd like to see. Bruno, you'd like to see gold? Okay, we'll take a look at gold. But let me just show you what's happened here now. So portfolio A is the portfolio with just the long stocks and short Bitcoin in about equal proportions in terms of risk. Okay, we have that 42%. Diversification. And portfolio B here, now we've added the bond trade. Okay. Our diversification went up to 52% and our exposure actually went down. In fact, I can compare them further down this table here. Okay. So Portfolio A has the long E-mini, short Bitcoin, okay? And portfolio B has the same long E-mini, short Bitcoin, and long treasury bonds. And by adding more exposure, okay, I didn't take anything off. I added the exposure to long bonds. I went up almost 10 points in diversification, and I lowered my overall exposure by $850. That's what we call a risk-free trade, okay? So that is giving me a huge boost in diversification. That's a winner. I'd be all over that like a duck on a June bug, as my grandfather would have said. All right, so I'm going to go back here and say, yeah. Let's bank that baby. And then I'm going to go down here and say, well, what else? Okay, here's portfolio B, the yen. Interesting. The yen is uncorrelated now to this 3 component portfolio. Let's see, gold is 15%. Okay, not bad, but I got some better bets in here, right? Natural gas, still pretty uncorrelated. Okay, going long natural gas would, get me some good diversification, 3.3 points. Give me a discount on my exposure. Oh, that's crude. Sorry, natural gas is down here, long. Gives me 5 points of diversification. And I can get $5,000 of exposure for $16,050. Okay. Let's add in the long natural gas because I am long natural gas. And it was 2 units. So we're going to turn on natural gas. 2. All right. I hope this is making sense to everybody. Let me know if you've got questions. I think it's really important to be aware of exposure and volatility and diversification during times like this. Again, I'm working on making this accessible to you through my RiskSmith tools. Right now, I'm showing you how I do it in my Skunkworks Python notebooks, okay? So we added natural gas long here. Our diversification went up 57% now. Our risk exposure, 10,957. I think that's about the same as what we had for portfolio A, right? So portfolio A, now we added the bonds to portfolio A, so our diversification was up more. But we can see, we added 3 points of diversification and we added more exposure at a discount. All right, so now what else might we consider adding? The yen. Let's look at the yen. Last one. This is an important one to look at just because everybody's watching the yen right now anyways. So if we went long the yen, we could get $5,000 of exposure for $281. That's pretty cheap. And we'd add 5 points of diversification. If we went short the yen, again, we can get $5,000 of exposure for just $1,870 of exposure. But we'd get less diversification benefit. So let's go have a look at the yen and see what is happening with the yen. This one, I think we just got to go look at the charts. All right. So this is the yen futures contracts, okay? Let's use a little less data. So cycle, number one cycle is 124. Looks like it's bottoming. And it's a little hard to see, but we've got, momentum turning up a little bit. Not decisive, but maybe. Not bad. Okay. If we look at the number two cycle, a little longer term, right? That's got some down ways to go, but definitely some uptrend for the next few days at least. Let's look at the dailies on the yen too. So that would be what is the ticker on Yahoo Finance? Let me just actually go over here. All right, now I have to explain something here, that this is inverted from the yen futures. So on the dailies, okay, this is the USD JPY ratio. So this means, when this is going up, it means that the yen's getting cheaper because you can buy more yen with your dollars. But here it's the opposite, right? So when this is going down, it means the yen's getting cheaper. When it's going up, it means the yen's getting more expensive. So this is pointing, for the yen to go up. And over here, with the bottom here, this is pointing for the yen to go down, okay? So sorry about that inversion. It's just one of those things you got to deal with. But, a short-term opportunity in the yen while it's bottoming here is something that we might look at. So let's go back here and add one more thing to our portfolio. All right, so we had, let's see, this was, what did we add here? Natural gas, all right? I'm gonna add natural gas to the portfolio A. And for the yen and portfolio B, we're looking at adding about 2 units. So we'll go now add that to yes, long, 2 units. All right, we're going to update this. Now we'll go down here and compare our 2 portfolios, A and B, right? So A has long E-mini, long bonds, short Bitcoin, long natural gas. And portfolio B has all the same, but adding the long yen, okay? By adding the yen, going long the yen, we added 5 points of diversification. We lowered our risk exposure by $154. We added another position. We didn't take anything else off. Okay, our target exposure is about $5,000 per trade. And we lowered our risk exposure. So now portfolio B has 62% diversification and $11,000 of exposure. So that is the way that I put together my portfolio of trades, that I get free exposure in the markets, and that I make sure that I have a diversified portfolio of bets. Because when I get in trouble is when I get fixated on 1 or 2 things, and the market starts to get me sideways and I start being reactive, and that's when I make my big mistakes. When I've got 4, 5, 6 different things going, all equally balanced, all, lining up with my indicators, I'm a much more sane trader, a less emotional trader. and I'm a much better trader. So I think this is very important. I'm working on these tools, a more publicly accessible version of these tools over at RiskSmith here. You can sign up for free. It's not quite ready yet. It requires some explaining. It's going to be free next week, so don't worry about rushing out and trying to, get into this before the door closes. That's not the situation at all. So the last thing I want to show you here, this is based on 2-hour data, right? So watch what happens when I go and change this to 1D. Okay, 1 day. That means what would happen if I was going to hold this portfolio for 10 days? This portfolio is not designed for that, but I want you to see how, different time frames have totally different levels of exposure and volatility. Okay, so our exposure in portfolio B, let me just make these the same now since we've decided that this is our portfolio. So I'll add the long 2 yen. Okay, and I'm changing this to 1D, okay, instead of 2 hours. So the portfolio exposure diversification went down from 60 down to 50 because it's a lot more data, longer time frame, it's daily data. But the exposure went from $11,000 to $52,000. Okay, if I'm going to hold this for 10 days, I've got $52,000 worth of exposure instead of $11,000 exposure. Conversely, I could go the other direction. What if I'm going to hold it for 20 minutes? I'm not going to hold it for 20 minutes. I'm using 20-minute bars. So 10 20-minute bars would be about 3 hours, a little more than 3 hours. If I said, I'm going to hold this portfolio for up to 3 hours, my exposure went down to $3,935. So, when Monday rolled around last week, right? When the CPI comes out tomorrow, one way to control your exposure is to start to operate on a lower time frame. Okay. Monday, I was on my computer all day long. I didn't leave. I had meals at my desk, right? Because I needed to be operating at a shorter time frame to manage that exposure and that volatility. This is part of trading, and this is trading market cycles. So this is how it works. Most people aren't using these tools, right? This is the tools that we use in institutions, but not the tools that most of us are using on a daily trading basis. And that's what I'm really working hard to make more accessible to us all. All right, so going back here, let me go back to the 2 hours. Just going to update this. I didn't forget gold. I'm going to take a look at gold. Let's just see kind of where it stands. We're back to, our 60%, 61% diversification. That's outstanding. About $12,000 of risk at the moment. Gold, if we wanted to add it to this portfolio, it's relatively correlated, not that correlated. 21% is pretty good. Going short gold would give us a little better diversification, right? I actually think short gold is interesting right now. If I go back and look at my table, well, everything's green in gold right now. The trends are all green. That's pretty amazing. The 20-minute cycle is bottoming, but we do have some bearishness on the 2 hour and the daily cycles. So let's take a look. What the heck? First, I'm going to look at the 20-minute cycles in gold. We're tracking the 370. Let's update it for the latest data. It's now out to about 397, so it's stretching out a bit. And Actually looks like it's topping based on this latest data. Let's try this 102 cycle down here. That's a little more bullish, but again, this 20-minute data, not my primary focus, but when I'm going to take a position in a 2-hour chart, sometimes I'll go look at the 20-minute data in order to see if I could time my entry a little bit better. Let's look at the 2 hours in gold. So where's that? I think this is it. Yep, 370 and 102. So the 2 hour in gold. Getting all the latest data. We got this 299, 149, and 72. So those are harmonics, you know, a 1, 2, and 149 to 299. That's a 1, 2 also. So that's pretty sweet. You know, more data messed it up a little or blurred it a little bit. Let's try using a little less data. It's about 1,500 bars, maybe a little less. And you can see when I'm going and adjusting, I'm usually working off a top or a bottom. So that would be about 1,200 bars. All right, so still that 257, 124. Yeah, not so good. I think I'll just stick with the AI. This number, this 124. Maybe a little more upside, but potentially nearing a top. So I'm kind of interested in a short gold here, but I have to take into consideration that the trends are all just green to bright green, but the 2 hour and the dailies are showing some potential bearishness, and I think gold is pretty overbought right now. So if I were I might take a small position in gold here, short. Normally, if I were adding gold, a full position is about 1 unit. So, okay. So let's say we added 1 unit gold here. Recompute. All right, so you can see the 1 short gold here, added 4 points of diversification. This portfolio is up to 65% diversification, and it only cost us like $300 more of exposure. By the way, exposure isn't the same thing as capital, okay? Exposure is, it's just not the same thing as how much money's in the account. It's how much volatility, how much movement in your position you would have to put up with over 10 periods for whatever those periods are. All right, well, that is a good 40 minutes. Let me see what y'all are thinking. So I hope this is making sense. I know it's more complicated than what you usually get on YouTube, but I think it's very important. In fact, I don't think you can survive without it, especially if you're doing shorter term trading. So that's why I'm taking the time. That's why I called it trading market cycles, because we're trading. We're using cycles to enhance our trading, but ultimately we're trading. And like Jack Schwager said, right? All the market wizards are totally different, but they're all pretty religious about risk management. Yes, they are, because you got to survive. You got to be able to survive. When you can survive, that's when you can take advantage of, unique one-off situations. Okay. But you got to be around in order to take advantage of them. All right. Can we review oil cycles a bit? Sure. Sure, but the diversification assumes correlation between the three assets are stable. Yes, Bruno. Good point. Let me turn that on so everybody can see. Yes, you do have to check up on your correlations. But I have found, and I'm pretty sure that the literature, academic literature supports it, correlations are pretty stable. Now, look, Sunday night to Monday morning last week, when it was a liquidity event, right? That carry trade unwind, that deleveraging was a liquidity event, and the correlations changed, right? But now they're going back, right? They're reverting. We've got mean reversion. I know correlations can change. That's absolutely right, Bruno. But they are a very useful tool, and you should be looking at them. I guarantee it. Let's see. Dave, do you anticipate creating a write-up on these portfolio tools? Yes. I'm working on it over on RiskSmith to make these accessible. It's getting close. I thought I might be able to show it today, but just wasn't quite there. The functionality is there, but the user experience is too slow. Got to speed it up. I'm going to be making videos. I'm going to be talking about it. It's really like, I don't think there's anything more important that I have to deliver. So yes, I am, Dave. Thank you. Somebody asked to look at oil. I'll wrap up on that. Let's see. Another question from Bruno. How many periods are the correlations computed? Great question. I use 250 periods. When I was looking at daily data, that's about 1 year of trading days. So 250 periods is what I typically use. And yeah, great question. And that does, impact what the correlations are. So I use 250 periods. All right, so we'll take a quick look at oil and then we'll wrap it up. So let me jump over here. Let's see what's going on with oil. Here's oil down here. Okay, so trends on oil goes out to about here. Definitely some negativity in the heart of these trends. The little longer on the 20-minute trends, the 2 hours, the dailies. Okay. Trends still negative, but cycle-wise, we got some positivity in the cycles, although bearish on the 2 hour right now. So let's go take a look. We'll start with the 2 hour. So got a pretty nice cycle jumping off the spectrum here. As Lars famously says, that would hurt if you sat on it. I love that one. All right, let's grab the latest data. Maybe take a little bit off the end here, commensurately. Let's look at that. Definitely diminished, but I still think it's there. This is definitely the most persistent cycle in the 2 hour oil around this 150. Okay. Topping. Let me zoom in here a bit. Okay. And also momentum curling over on the 2 hour. Cycle topping. There's this. Bottom going down for the next few days. We'll see. A lot of talk about Iran and Israel this week. Iran attacking Israel this week. I think, short of the news, crude would be going down, but it is a tricky situation right now. I've been long, for most of this move, but I covered most of my longs today. If we look at the dailies on crude, This is Yahoo Finance, so sometimes takes a little while to load. Let me just jump back over here and see while that's loading. Anybody has any more burning questions? Nope, looks good. All right, so on the dailies, on crude, we got a couple of nice ones on the spectrum here. This 174 and 370, nice harmonics. They stick around pretty good. Now 369, 174. Coming into a bottom. Pretty nice bottom. So I would say we could definitely see crude go higher. This 2 hour right now gives me pause, but this is a great setup right here where I love waiting to see if I can get the bottom, give it a few days. And if I see it coming in here bottoming, especially with a cyclic RSI buy signal, and I've got this kind of, harmonically supported confluence on the daily, the time above, I like it. So thanks for the question. I will definitely be keeping an eye on that one. All right. Well, it's been great spending a little time together again this week. Thank you for checking in. Let me know what you think of all this. I'd love to hear from you. Is it making sense? Do you want more of it? So in the meantime, thanks for tuning in, and I'll see you again next week. Be careful out there.